Okay, so I'm now recording the meetup starting right now. All right, so let's get right to the, I'm going to switch back to the sample trading plan real quick, and then show you how we take that and go to the charts. All right, sample trading plan. Everything we do has a trading plan, and it will show you. This isn't a this is not the detailed plan. A detailed plan has all the setups, all the settings for all the indicators, has exactly when to trade, when to not trade, has a lot more detail. But the general format of what we need to look for in the charts is a setup, trigger, and trade management. That's terminology I got from Jake Bernstein. The setup is visually what you look for. For this one, it's telling me I'm looking for a Donchian mean line crossing over a 40-period simple moving average. All right, and this is the trigger conditions. And the trigger is a confirmation. Visually, I look for the setup. And once I see something to actually look at, that's the setup. Then I go into detail and look at my trigger and confirm all the details. Then I know I have a good trade to go ahead and take. And then I'm going to be, trade management is buying calls or buying puts, depending on the strategy, long or short. And this might be 2 sentences, but this is what we spend 2 to 3 hours on during one-on-one coaching sessions, going through this. This is where all the time is spent, how to manage the position. Trading isn't as simple as reading 2 sentences and knowing how to do it. It is not that easy. You have, so don't get fooled by 2 sentences and think you can do that. You can't. It takes a couple hours for me to explain in detail. All different scenarios will come up, especially with options. It's not straightforward. So especially option selection and just buying calls and puts, we can't pay too much for an option or else you won't make any money. So we have criteria for that also on how to not pay too much. All right, let's go ahead and switch over to the charts. And from here on in, it'll be focusing on the charts. All right, before we go on, any questions so far on anything? Like I said, go ahead, you can unmute, ask questions, or type it in, and I can respond. Feel free to interrupt me anytime. All right, let's go to the charts then. All right, what you're seeing right now on the screen should be the S&P 500, SPY. And the strategy we're looking at is the Donchian crossover. So if you take a look at your trading plan on the handout, the setup is the Donchian mean line crosses over the 40-period simple moving average. All right. So the Donchian channel consists of 3 lines, an upper, mean line, and a lower. We are not using the upper and lower line, so I just made them transparent so we can't see them. This dotted line above here is an upper Bollinger Band. The Bollinger Band consists of 3 lines, upper, middle, and lower. We're not using the middle and lower, so I made them transparent so you can't see them. Otherwise, we just have a chart with a whole bunch of lines on it that's not being used, right? And this blue line is a 40-period simple moving average. So we have the 40-period simple moving average is the blue line. The Donchian mean line is the orange line. And this dotted line is the upper Bollinger Band, okay? And for this strategy, what we're looking for is the orange line to cross over the blue line. We're looking for the Donchian mean line to cross over the 40-period simple moving average. That is the setup. That is visually what we're looking for, okay? There are people who write programs to find it, great. But that's visually what we're looking for. So this day was a couple of weeks ago. What we would see on this day, we'd be going through our charts after hours. We do not do any of this with live data during market hours. This is done after 1 p.m. Pacific, when the stock market is closed. We do everything end of day. We're not day traders. We do not look at intraday time frame. We do not sit in front of a computer for hours every day. Just don't do it. Doesn't happen. That's a different type of trading. Everyone starts out day trading, doing like that, sitting in front of a 1-minute chart, a 233 tick chart, 5-minute charts. 1 hour. Everyone starts out doing that because usually people don't know any better. That's what they've seen on TV. That's what they've heard about. But as time goes on, like any other business, when you start out, let's say a construction job, you might be the person digging the hole. As time goes on, you'll be supervising a team of people digging holes. And as time goes on, you are the manager sitting in the office, setting up all the time schedules for all the people, all the other people. As time goes on, you move up, you move up. This is moving up. We all start out sitting in front of the computer for hours and hours and hours, trying to work for every penny, stressing out, trying to do a real complex job financially, making significant financial decisions in real time. And it's not that easy. And most people end up losing a lot of their money. This is done in a very relaxed way. You have 17.5 hours to do this after the market closes. It's 17.5 hours until the market opens again. Very relaxed. Sometime after 1 p.m. Pacific, I go through my charts. I look for 2 lines crossing. Hey, if it was a day before, the lines didn't cross yet, so I have no setup, nothing to look at. Next ETF, next ETF. The next day they crossed. Hey, now I have something to look at. It's literally that simple. If they didn't cross, there's nothing to look at. Now they crossed. So, and it says on the plan for the trigger. So now I have a valid setup. They crossed. Trigger. It has to close below the upper Bollinger Band. And if you can't see with your eyes, look at the data box for the Bollinger Band value is 457.22 is right over here. The data box is upper Bollinger Band is 457.22. And the closing price is 455.96. So it closed below upper Bollinger Band. And there's also criteria for the certain number of days in a previous bearish cross, totally met, that we go over in detail when I'm coaching people. For number of days, this orange line has to be below the blue line a certain number of days before it crosses up. Also, it would be considered choppy and we pass. So we have a nice crossover, and then we check our stat sheet, make sure it's over 84%. Now, how do we know how do we make money? Okay, here's how we make money. The stat sheet will show it's over 84% wins. What does that mean? A win we define as when our first profit target is reached. Our first profit target is based on volatility. It's not option volatility, it's the volatility of the underlying instrument, in this case of SPY. And how we measure volatility on the underlying instrument is using the ATR, which is average true range. That indicator exists on every single trading platform in existence, okay? So we use, if we take a look at a data box that says ATR right here. On this day, the ATR is $3.61. What that's telling me, and I use a 5-period ATR, it's telling me on average, every 5 days, SPY is moving $3.61. If you were doing option type stuff, pure option analysis, you'd be looking for option volatility and doing also the more complex calculations. We're looking at the underlying volatility, $3.61, done. That's our first profit target. We're gonna take profit when SPY moves up $3.61 from the next day's open. So Becky, can you pull out a calculator, or someone else pull out a calculator? I'm gonna ask you some numbers. So we have a valid trade. We know it's over 84% wins. So what we have to do is to buy a call options the next morning that's in the money. So the next morning, the market opens at 456.45, which would make the first in the money option the 456 call options. So we know when the market opens, we're going to be buying the first in the money option, which is 456. Now we know how big our target's going to be. It's going to be $3.61. We're going to add $3.61 to the open price of the ETF the next morning. So Becky, or anyone else with a calculator, what is $3.61 added to 456.45? The open price the next morning is 456.45, and the ATR the previous day was 361. Okay, we got a people typed in 460.06. All right, great. So now I know how big my target is. It's $3.61. I know if I take this trade for this strategy, I have 84% chance or higher of reaching my first profit target before option expiration. All right. I know my entry price is when the ETF is at the open price or lower. You can get in lower. Lower is great. Those are the best trades. But I have to get in when the open price of an ETF is, when the price of the ETF is at 456.45 or lower. And my first target, as people have calculated, is $460.06, $460.06. So I'm buying my call options the next morning. The next morning I buy my call option, then what do? I have no need to sit at my computer. What I do, I put in a conditional order to sell all or part of my option position when the ETF reaches $460.06. Okay. So it's the first in the money option, which would be the 456 strike. And it will either be one expiration cycle or two expiration cycles out. An expiration cycle is defined as we only deal with the third expiration, the third Friday of the month expiration. We don't deal with any of those other ones they've created, all those weekly, daily options. We don't deal with any of that stuff. That's the stuff they created over the last 15 to 17 years. The option that's been around forever, the third Friday of the month, the standard option expiration, that's all we deal with. So from the Monday after expiration Friday until the following month's expiration Friday, that's one cycle. And then again, third Friday of the month is all we deal with. So the Monday after that third Friday until the following month's Friday expiration, that's one cycle. So all of our trades are either using one expiration cycle or two expiration cycles. That'll be on the plan. Okay. So we buy our options the next morning, and then we put in an exit order. The exit order is a standing good till cancel order that says sell to close either all your contracts or a certain number of your contracts when the ETF, not the option, when the SPY goes above $460.06. Okay, the next day, the high was 458.40. So you're in the next day, your target has not been reached yet. The next day, it reached a high of 459.56. Target not reached yet. The next day, it reached a high of 460.70, and our target was 460.06. So this day, your target got hit. Okay. Your trade will automatically execute. You didn't have to be there for 1 single second in those days. Once you place your order, you can walk away, go live your life. Your trade will execute, and it will sell to close either all your positions or a part of your position, depending on how you choose to manage your trade. If you do nothing but place 10 to 15 trades a month, and you exit your entire position at the first target, meaning you just sell, you bought 5 contracts, you sell 5 contracts. You don't want to deal with position management. You're too busy. You just don't want to. It's not in your personnel. You don't want to take the hassle of tracking it. You're too, whatever it might be, you have to work too many hours, just too tired to think about it. You just want to make some money and you're happy. That comes out to approximately 10 to 20% annual return on account if you risk about 2% of the account per trade. So if you got a 50 grand account and you're risking $1,000 per trade, that comes out to about 10 to 20% return. That's real straightforward. If you want to make more than a 10 to 20% return, then you have to do more than just the first target. Then you have to have second and or third profit objectives and trail stops. So if you want to make more money, you have to do more work and try to catch some of the bigger moves, okay? A question here. After buying the call, as you are monitoring each day, do you need to be concerned with the ATR of each day until the day? No. Once you place your trade, there is nothing to do. You have done your work. The market will go up and down every day. You have 1 to 2 months or more sometimes for the target to be reached. There is nothing to do. There is no involvement. You have to go find something else to entertain yourself to do, whether it's work, play, hobbies, whatever it might be, education, trading, education, do something else, anything else to do. There's nothing to do with that trade. That trade is on its own. It doesn't require your involvement until the first target is reached. If you have additional contracts you want to trail stops on, but there's nothing else to do. This is carefree trading. This is what's allowed me to have a life, to be able to, like I said, my work day is an hour a day. It's an hour a day trading. There's no more than that. It's just to manage my positions once a day if needed. Usually not even needed in most cases, but that's it. Nothing to do, no adjustments, nothing. Just leave it alone. Eventually, you're going to have trades going your way, trades going against you. You will have more than one trade on the same ETF. Just place the trade, walk away. Okay, to clarify. An expected return. Okay, this is for David, clarifying. An expected annual return. Expected return is 20. The expected annual return on account, not return per trade. The annual return on account, if you do nothing but just trade the first profit objective, is a 20 to 20% return on account if you're risking 2% of the account per trade. Yes. On the expected return on a particular trade at just the first target would be anywhere from most winning trades or anywhere from a 5% to a 30-something% return on most winning trades in that range. Since they're options, you have no idea what the return is going to be until it happens. Because there's so many variables in option pricing with the Greeks, you have absolutely no idea. You can get gaps, you can get a fast moving market, will give you different results. So volatility is a big factor. So we don't know how much you're going to make until you make it. That is a big reason we maintain that high percentage wins, because realistically, even at 84% wins or higher, you still, to guarantee profitability, you want to have 5 to 7 wins for every 1 loss to guarantee profitability, since you really don't know how much you're going to make on a particular trade. You know it's going to, on a winning trade, will be anywhere from a 5% to 30-something% in most cases. But to get, so you got to understand the math involved, where a lot of people lose money or lose faith. You don't fully understand the math and the numbers involved. So you got to think about that. If you are at 70% wins, how much money do you have to make on every trade, winning on average on a winning trade, to be profitable? And how much money what's your max risk? So if you don't run all your numbers, you might not lose money, but you may not make any money because you haven't run all your numbers. You need to know how much you can risk maximum on a trade versus the percentage wins and how much an average win is. So it's all a balancing number of balancing act of dollars and cents. So I got a question here. If a trade goes south, when do I exit? You don't exit. Your risk is set when you place the trade. Your risk is your 2% of the account. That is your risk. There is no stop loss. There's no hard stop. You can't, we don't just, this is not a type of trading where you have a stop loss. That's a different type of trading. So we don't just arbitrarily make up a stop loss, and we can have a trade, you can have an option go 90%, 95% against you, be worth almost nothing, then double in value from what you paid for it. That happened last year, February and March, when the market dropped and dropped and dropped. There were options that were not, that had dropped in value 90%, literally doubled in value the first target. That's the benefit of trading options, just calls and puts, and not having to deal with adjustments and hard stop losses. So when you have the 2 to 3 months worth of time, what you pay up front, your 2% account risk, that is your stop loss. That is your max risk. So there are no big losses. It is impossible to have a big loss because you're not risking more than 2% of the account. But you don't limit how much you can make. How much you can make is not limited because of trailing stops, so on and so forth. So back to this question, answering questions here now. On average, if following the strategies per plan, how many losing months are expected per year due to trades expiring worthless? So this is a big, so what David asked is a big picture question. A lot of people freak out when they trade a strategy and they get a couple of losses, they stop trading, or they lose confidence, because you really have to have a big picture view of what to expect. So let me explain to you losses. At 80-something% wins, you are guaranteed beyond any shadow of a doubt to have at least 3 losing months per year. Losing month defined, you have lost more money than you made that month with closed trades. Only closed trades count. Open trades mean nothing. You'll always have open trades going against you. If you don't have open trades going against you, you're not a trader. You mean you're not doing anything. If you're a trader, you're actively trading, you will have trades going against you. All right. So only closed trades, but at least 3 months a year, you will have a net loss for the month. Guaranteed. Then you will have 3 months of winning trades to negate those 3 months of losing trades. The other 6 months represents your profit. The other 6 months represent your profit for the year. If you have a great winning month, next month you have a losing month. So now you lost everything you gained the previous month. Suddenly you lose confidence. The next month you have a losing month again. So now you have 2 losing months and you have confidence is lacking. The next month might be break even. The next month you have another losing month. So you've had 1 winning month, 2, 3 losing months, and 1 break even month. And this is a new strategy you started trading. You just stop trading it. You can't. You have to understand the big picture, understand your stats, and trust the methodology and keep trading, because you have to know that you don't know which 6 months will be your profitable months, but that's the way it works. You got to keep trading to get those profitable months. You will get 3 losing months per year, negated by 3 winning months. The other 6 months will be your profit for the year. So you have to keep trading, get through 6. That's what I tell people. You got to get through that first 6 months of trading to really start understanding the profit and loss and building confidence in yourself and me in the strategies, in the system and methodology and trade management. It's not just about what happened this week or this month. It's a big picture. Right? Got a question. If VIX is too high, trade method proven. The VIX has nothing to do with anything. We don't analyze VIX. We don't analyze option volatility. We take buy and sell signals. If the more volatility there is, the better it is for us. The more vol there is, the better it is for us. Let's take a, I'm going to scroll back to last year, 2020. We live for volatility. That's how we make money. This is when last year, when the market just got destroyed for several weeks. VIX, for the person who asked the question about the VIX, what was the VIX during this time in March and April? How high did the VIX get? If you can look that up, whoever asked the question. Anu? Yeah, great. This is our most profitable trades. When we were in the short trades during this whole time here, we had trades that doubled and tripled and doubled in value at the first profit target. Usually the first target I was saying, we're usually up anywhere from 5% to 30 something percent. We were up 70, 80, 90% on the first targets because the gaps were so massive and volatility went up so high. And also what happens as let's take a look at the ATR. The ATR we looked at from a couple of weeks ago was 3 points. The ATR, take a look at the volatility here, 15, 17, 18 points, 8, 10, 11. So what happens, the option pricing will go up, will be higher as volatility gets higher, options get more expensive. But what happens, the ATR gets bigger. So we have, our targets are now triple, quadruple, quintupled the size. So we're trading with such big targets now with the volatility. Instead of having what would normally be a 1 ATR of 3 points is now 9 points, 12 points, 15 points. So the targets got so much bigger. We love volatility because it makes our profit objective so much bigger. When the first target is hit, the profits just go from that normal 5% to 30% up to 50, 60, 70% because the profit targets are so much bigger. The option price only goes up so much. The ATR prices go up so much more, it blows away the targets and it's like, wow, okay? So this is, yeah, we trade long and short. It's not just long trades. We trade long and short. We have sell signals, buy signals, we sell market tops, we buy market bottoms with different strategies. And the Donchian cross, it usually comes off when we get to a market bottom and turning up, we get the Donchian cross. But yeah, we buy calls and puts and it's awesome. So we live for volatility and most of our put trades happen right here. Right here, we have a sell trade. Right here, we have a sell trade, okay? I have to show you on a different chart. All the details are in here on this particular chart because there's more stuff to put in, but we have multiple sell trades happen right here. Multiple trades that were initiated over here. Multiple trades that were initiated over here going against you for 2 months. And then those are the ones I was talking about that the put trades where you thought was going to be expiring worthless, all of a sudden double, tripled in value. When we got to a point right about here, people were like, we're out of our positions, we made off our money, what can we do? Nothing to do, you're already out, you made all your money, you've double, triple your money, and there's nothing to do but wait for our next set of buy signals. That's the way it was. So this was all COVID driven, massive, massive, massive drop gaps every day. But yeah, we live for the volatility, long and short. All right, question, let's see, sorry, I missed this. What is I'm not sure what DTE. What is DTE?
Date to expiration.
1 to 2 expiration cycles, depending on what the plan shows. With expiration cycle being from the Monday after expiration Friday until the next month expiration Friday, that's 1 cycle. So the trading plan will show you the win-loss stats for 1 expiration cycle, and it will show you the win-loss stats for 2 expiration cycles. The listing I showed you in a spreadsheet that's also on our website, that's all based on 2 expiration cycles. If you see stats for 1 expiration cycles, there's usually a lower win percentage and a lower upfront cost. So if you want to make a business decision to go with the lower upfront cost and a lower win percentage, you can. But if you really want to get the exact same results we show on the spreadsheets, then you go with a slightly more upfront cost, but a much better chance of having a winning trade. So those are business decisions we make as traders. And so I guess the bearish trend, we need to see the lower Bollinger. For the bearish trade, totally different strategies. It is not the same strategy in any way, shape, or form. completely different strategies. So we're not looking at low Bollingers, so it's totally different strategy for the short trades. A lot of people try to flip trades around. They have a great long trade to flip it around and I'm losing all their money. Trading long and trading shorts are completely different. They do not work the same way at all, So let's go through this real quick here. Let's go back to the chart. I can just sort of scroll forward. Coming out of this massive bearish down move, Donchian cross, orange line crossed over the blue line, close below the Bollinger Band. Good trade. Scrolling forward. Orange line crosses above the blue line. We buy our call options the next morning. It goes against you for several weeks. You don't care. That is why we don't use hard stops when we're just buying calls and puts. That's the benefit and the power of just buying calls and puts. We don't have to have a hard stop, as long as you have good risk management. If you are someone who's trying to put, you have a, let's say a 20 grand account and you buy 5 grand worth of calls, you're screwed. That's, you're way over leverage, no more than a 2% account risk per trade. I know some people might do 3 if they're really crazy. I see Henry in the waiting room there. Is that actually in the waiting room? I see that, Becky, is that actually Henry there? All right, so, but you buy options the next morning, call options, ATR that day, $5.06. It opens at 348.96. Your first target is going to be up here someplace, and I think it actually was this gap day. This is a gap day that happened last November, and I remember this day because everyone in our trading group, in our Facebook group, loved this day. I didn't realize this, the trailer I was looking at, but I had actually messaged people that evening on the Facebook group, and I emailed some people directly that the futures were showing a massive gap up that next morning. So to be ready for it, because this one trade alone times 6 to 9 different ETFs. In this one trade alone, it basically doubled our annual profits and all the other trades combined. Okay. This one trade alone doubled annual profits. Why is that? That is because it went from, this is 348. So it made our target what was it, about 5 points. So our first target was supposed to be about 352. This would be 353. This was supposed to be our first target, 353, right about here. The market gapped beyond the first target. So now when it opened at 363. So instead of having a 353 first target, our options executed at 363. Way deep in the money, which made our option prices times all the different ETFs we were in just explode massively. We're talking more than doubling in value in one trade, kind of multiple trades. So all the people who were trading this strategy that one day, and then to make it even better, you get in, took massive profit, take part of the trade off, put your stop loss in, and it kept going up. So last year, November, was just this massive, memorable trading month. Some of you, I know some of you were in it. Connie, were you in this one? I think you were talking about it. I know that a few people were in this trade, and Jessica. It was just that beautiful November trading. Connie, you there?
Can you hear me?
Yep. Were you in this one last year?
I was in it. It was like the slot machines were going.
I know. Everything just gapped. And that's exactly the way she sounded a year ago too, when it was happening. And these type of things happen periodically. And the reality is they will happen a lot more often than not in your favor. A lot more often than not, right? So you can never have a big loss. This can go against you. It cannot be a big loss because your risk is fixed risk. Going for you, you can trail your stop and there's no limit on how much you can make. That is the big difference of how we trade. And that's why we don't do spread trading. It's like, if you were doing spread trading, you'd be getting in, oh no, it's going against me. I need to adjust this, adjust this. Oh no, it's going the other way now. I have to adjust this, adjust. No, none of that. We're done with that. That was way in the past, like 2009. But that's how we've grown as traders, pure directional. You get these big moves, maybe 2 or 3 times a year. But most of the time, you're going to be making that 5% or 30% return the first target, and then you can trail your stop for more. But these big trades, especially this time of year, happen regularly. This time of year is our most profitable time of trading, the same as last year. It just sort of does work out like that seasonally. You see a lot of buy signals, even better, because seasonally we expect long. When you see buy signals, great. And even this gap here, buy signal, orange line crossed over the blue line. New buy signal, new trades to take. Kept going. Orange line crossed over the blue line, the one we were looking at a little while ago. Kept going. Comes back down. Orange line crossed over the blue line. Right here. Buy your call options. Pull back for a couple of days. Takes off again. This is a couple of weeks ago. Orange line crossed over the blue line. Buy your call options. That is the Donchian crossover. So when you look at the spreadsheet and you see where it says Donchian cross, that is the Donchian crossover trade that's happening on those ETFs. All right. I'm going to change spreadsheets here real quick to show you just the Donchian strategy. So this is one of 6 strategies. So we trade a group of 6 strategies together. With the 6 strategies together, we buy bottoms, we buy market bottoms, we short market tops, and we take trades coming off the bottom, and we take trades already established trend up, and we take trades that are already in an established trend down. So no one strategy can trade everything. That's why you trade a group of 6. This is just one of 6. I'm going to switch templates. I'll switch charts, right? Hang on a second. All right, I'm sharing with you now. This is also on the website. These are just the Donchian trades alone, just the Donchians. It's a group of 4 set strategies, 4 out of 6. Just Donchians alone since 2019. There have been 765 trades, 625 long, 140 short. Overall, 90% winning trades, 10% losses. This is the list from 2019 to now. I asked Becky to put this together so you get a feel for what to expect. And you guys can download this right up to now or throughout end of October. She updates the list every month, but it gives you a feel for what strategies come up valid. There's just a Donchian. There's still 2 more: the Keijin hook and ETF sell, squeeze sell. So there's still 2 more, but this gives you a feel for just the Donchians. And there were a couple of people I was talking to who are current coaching clients. Remember, I was saying at some point in time, you may want to specialize. Maybe you just want to trade the Donchians and nothing else, because just trading the Donchians and nothing else gives you the absolute best results, trading just the Donchians and nothing else. The list you see here for my current coaching clients, that is every single ETF, regardless of if it's over 84% or not. Okay, that's every single ETF combined. All right. Think about the ones that are only over 84%, what the results would be like. That 90% would be moved up to about 93, 94%. Keep that in mind. Okay. So when you really narrow down what you want to trade and get focused, and that's what I help you do, get focused on what you want to trade, how you want to make money. Requires some self-control and not try to trade everything. But then it gets really super profitable. But just focusing on just the Donchians, 90% wins. If you include the other two strategies, there's one for selling market tops and one for buying market bottoms, then you factor those in too, and those are also great. Because some people just like to sell market tops. I love selling market tops. So there's certain ETFs I trade for that. I don't trade them all. I trade certain ones and stay consistent with that. And that's how I get my best results. All right, so let's take a look at questions. Okay, got a bug. Okay, Sanjay, I'll catch you later. Crossover mean Donchian in this table. In the table, Donchian, yes, the crossover is a Donchian crossover. In the other table is Donchian cross. The Donchian cross a crossover, yes. And let's see, strategy showing. What is the address of the website? Okay, Becky actually posted it to everyone. What is the address? Okay. That's what the strategy. Yep. Is a strategy. Okay, so good. All right. So far, do we have any questions or anything I've gone over? Any questions so far? Feel free to unmute or type something in. I'm going to go back to the handout, show you an example which I put in there so you can reference it on your own when you're going through things. Should be sharing the handout now. I put an example of XLB, which is one of my favorite things to trade. Okay. I just posted, okay, just posted it to Becky only, everyone in meeting. Okay, I just posted the link again for the handouts. So you should see that. All right, what you're seeing now is XLB. I listed all the dates that this trade setup has happened. So that's something to go back and take a look at. If you're setting up your own charts, then you can kind of get a feel. You can verify you have the charts right by looking at the dates. For my coaching clients, I will provide you all the charts for NinjaTrader and for Thinkorswim. It will all be set up for you. There's nothing for you to do. I will have all the parameters preset. The charts, your charts will look like the charts I just showed. And I will also have a version for Thinkorswim. So everything's all done for you. Try to do this yourself. It won't be the same. It will guarantee not to be the same. All right.
Hey, Eversley.
Yeah.
Someone asked the question, so I was wondering, I know you do Forex, but I don't know if you do commodities.
You know, I have transitioned from Forex back to futures.
Uh-huh.
So we're focusing on currency futures and index futures. So Dow, NASDAQ, S&P, and Russell 2000 futures. And for currency futures, it will be the Euro, Australian dollar, British pound, Swiss franc, and Canadian dollar futures. That's it.
Oh, so not the yen.
No. It was just too complicated, the numbering system to analyze and work with.
Okay.
It's a different numbering system.
Yeah.
So just not yen by itself, no. And I've done the presentation on those. And if you go to the same website, there's a video link to the presentation on the futures. Something you might even think about some point, Priya, because the futures are literally 2 to 3 times as profitable than the options, with 1/3 as many trades and none of the variables that options contain. So futures become it's just easier to trade,
Yeah,
because you don't
I've
have
been
all the
thinking about
variables.
moving to futures.
Yeah, it's just easier. And this is what we used to do a long time ago. We only stopped because the margin got too high. But now that we have that we can trade in micro futures, we can get back to reality and not have to risk, $15,000 per trade or something, because yeah, now we can go back to regular trading. And if you want to risk $500 on a trade, on a futures trade, swing trade, no day trading, no sitting in front of a computer, same type of strategies. So the futures is the same type of swing trading strategies. Look at a chart, 2 lines crossing, a hook up, look for the stats, the same type of approach, but all swing trading, no day trading. So
Cool.
it's real easy. And I know if you talk to Jessica in the last week or two, she'll tell you she's been having fun with futures. Because the money's coming so quickly, and then you get back into it and in different ways to, yeah, it's just really nice trading. Okay. Yeah, the commodities, because the only reason we're not doing commodities is because we can't show you those on regular charts from a brokerage. You would need a professional data analysis platform, which is going to cost you a couple $100 a month to even have the right charts. The people who try, because we don't day trade, we swing trade, the broker's platform does not have the capability to produce daily charts showing the proper contracts. Meaning, with the index futures, it's a new contract every month, or excuse me, every 3 months. But with the commodities, there are 7, 8, 9, 10 contracts all trading right now at the same time. So if you want to trade a December contract, we need a chart that only shows December contracts going back 20 years and nothing but December contracts end to end to end to end. And that's not available at brokerages. You have to have your own platform, analysis platform you are paying for. So that's the reason we don't show stuff like that, because it requires a lot more cost and time. So we just focus on what we're really good at. Doesn't take much time or analysis. It's just easy trading with those index and currency futures. And plus the profitability is outrageously high.
Yeah, that's the kind of trading that Jake Bernstein does.
Yeah, it's just easier. You don't have to do anything. The money just comes, trail your stop each day. And remember, Jake doesn't move stops himself. He pays someone to do that for him. So he learned, he said, if he does it himself, he'll interfere with his trades and mess it up. So he hires someone to do all that for him. He just hands them, here's the trades, manage it. I'm not there yet. All right. So I gave you the example of XLB. So you can go back and reference the trade dates, and also IBB, biotech. So here's an example of, we have stats for 1 expiration cycle and 2 expiration cycle. This is why we need the stats. This is why so many people lose money, because they just sort of wing it. They don't know what expiration month to buy, what expiration week to buy. They don't know. They just make stuff up in their own heads because of whatever reason they just made up. But unless you have the numbers to back it up, you're going to lose money because you have no expectation of profitability. Keyword, this is business. You have to have an expectation of profitability. And if you think of it like a business, can you take this business model, show it to any other professional, and have them understand what you're doing and acknowledge what you're doing? And if you can't, then you shouldn't be trading it, because you don't know you're going to actually make money. So anything you see in a box, that's what Becky does. She does all the analysis. She's a data analyst, database manager. She puts everything in boxes, tracks all the numbers, tracks everything. I don't do this at all. I hate putting stuff in boxes and doing all this analysis like this. So she tracks everything and then sends me the final results. So I know that if I'm going to buy IBB calls with the Donchian crossover buy strategy, if I do 1 expiration cycle, I'm going to expect 80% winning trades historically. However, if I do 2 expiration cycles, 93% of the time, the target will be reached before expiration. Okay. And when you run all your numbers, you will have, sure, you have a lower upfront cost going one expiration cycle out because the options are cheaper, but you have a whole bunch more losses. And for every one loss you have, it takes 3 to 5 or more wins to make up for it, probably 4 to 6 wins to make up for it, because you don't know how much you're going to actually make on an option trade. So you need to think about that too. But when you have all the numbers in front of you, it's smarter. It's smarter. That's why it's smarter to be more conservative. You will end up making more money in the long run by having fewer losses. If you have fewer losses, you will end up, but have slightly higher upfront costs for that, you will actually end up making more money because you will have less losses. One of the biggest ways we've made money over the years is by not having many losses. Okay, but this would be a good example of knowing your numbers. When I have IBB valid, I am not going to go 1 expiration cycle, I'm going to go 2. If you don't have your numbers in front of you, and this is what we provide for anyone we're coaching, the stats. I'm going to go through, I'm going to switch documents here for a second and show you what I mean by the stats. As an example, let's see, give stats. Okay. You're seeing now are the different sectors we trade again. And this is one of the weekly chart strategies. You see what the numbers are like. If it's shaded in light blue, it means it's 84% or higher wins. If you see it shaded in light blue, 84% wins or higher. It's another one of the weekly chart strategies. If it's shaded, if it's 81%, we're not touching it. 80% not touching it. It has to be 84% or higher in the shaded light blue. Once again, this is one of the weekly strategies. This is one of the daily chart strategies. This is one of the Donchian's daily chart strategies, the T-line buy sell. Okay. This is the long side. Here are the stats with 1 expiration cycle. You can just look at how many more light blues there are on the 2 expiration cycles. Okay. That's how we know what to trade. Now, if you, these are the situations where you make business decisions. If you're trading DIA, you know your best bet is to go 2 expiration cycles, 90% wins. But let's say you have a smaller account. You can't really afford to go out 2 expiration cycles because the options are too expensive. The more money you have, the more choices you have as to what you can trade and how to trade it, like anything else in life. The bigger your account, the more choices you have. But if you have a smaller account, you may opt to pay less upfront and but also accept a higher probability of having a loss. Okay. So there are choices you make every day, every week with trading based upon your personal reality, your own personality. I know people who doesn't, regardless of what the stats are, they go with 2 expiration cycles, no matter what. I know people who have smaller accounts, so they have to go 1 whenever they can because they just don't have the account funding to do, but they want to trade, so they have to accept the higher risk of maybe having a few more losses, but still have a good profitable trading account, but you will have to pick up a few more losses. So it's all an individual thing. Next strategy. This is the short side of T-line buy sell. This is for the short side. Take a look at some of these. Never had a loss on it. Keep going down. There's another Donchian strategy, a hook trade. See the difference between 1 expiration cycle and 2. This is one of our favorite ones. This is 90%, 93%, 94% wins no matter what. So when I see a hook trade come up, I try to jump onto these, the ones that are 90-something%. I try to jump onto those because that's been very consistent over the years with the hook trades, and it's just cash flow. Just readily just shows in a spreadsheet with all those trades that which are wins. That's how it is. It works. And this is a strategy for buying market bottoms. This is an Ichimoku strategy. This one is for buying market bottoms. This is the first one that becomes valid usually after market pulls back, is this one. Okay. And this is the one for market tops. This is the one we short markets with. With this strategy, we will be in early on every single market top. A market cannot go up and come down without seeing this strategy. Okay, so when this strategy becomes valid, we see market tops. We can go back to 2007, 8, 9, and see when the market went massive up and then massive crash. We go back up to last year, see all the ups and massive crash in February. So this was our most profitable strategy last year, February and March, because we were in early. And with this one in particular, you get in so early, the options don't have a chance yet to get really expensive from the increase in volatility. So as a result, we get into the put options when they're still really cheap, and then capitalize on the volatility going up and juicing up the option prices all the way down. So that's the benefit of this strategy. We get in so early, the prices of options have not gone up yet. All right, so I'm going to switch back. This is one of our future strategies, and the profit and loss and the percentages, one of the futures, but I'm going to switch back to the handout. Okay, does anyone have any questions so far? Let's take a look. The blue color sells me.
Eversley, you just now explained something, and I just was blanking when you
Yeah.
said that it's a strategy that you can get in before.
You're kind of breaking up a little bit.
Oh, it's a, oh, because my connection. You said a strategy that you could use to get in before the market goes up.
Before it goes up, the ones that for the market bottoms are the Keynesian 5 hook.
Okay.
So the Keynesian 5 hook is the one that gets you in early, and also the market internals. The market internals get you in before anything else. And for the regular technical strategies, the Keynesian 5 hook is the one that gives you the first hook up after the market decline. You'll find several of those happen in the last month after the market pullback. What does blue colored cell mean? Sorry, I missed that. What is being calculated there? Oh, the blue color, those are the ones that indicate it's over 84% wins. So the light blue cells are the ETFs and expiration that shows you those are the ones that have 84% wins or higher. What is the significant 84%? Well, if you have 84, what's significant of 84? Our goal is 80 with a 4% margin of error. So if you have, let's say you are at 85% winning trades, 85 to 87% winning trades. And do you have a calculator? Pull out a calculator. I'm going to answer your question with some math. So get a calculator ready to go. You're risking $1,000 per trade, and you have 20 trades going on. You place 20 trades. At 85 to 87% wins, you're going to have 17 wins and 3 full losses. With the 3 full losses, you are going to, this is worst case scenario, absolute worst case scenario. You're going to lose $3,000. Anyone can do this also, so anyone get a calculator out. If you have 17 trades, risking $1,000 per trade, and you're at 85 to 87% wins, you're going to have 3 losses. That's minus $3,000. On the other 17 wins, you are going to average approximately a 25% return. So what is 17 times? This is very low end right now. I'm not even going high end. What is 17 times 250? What's 17 times 250? We're talking low end, worst case scenario. Okay, 4,250. 4,250 minus 3,000, 1,250. That's the worst case scenario. So your wins minus your losses. That's maybe a month, month and a half of trading. That's the worst case scenario. That's really worst case scenario because you have trailing stops. So that calculation was based upon doing nothing except the first target. That was based on doing nothing but the first target, nothing else. If you want to make more, you trail stops, so on and so forth. But that's based on doing nothing, absolutely nothing but the first target. Can I suggest that a better metric would be expectation of a trade? Let the average profit is going to be 20 to 30% average. That's why I said 25, right in the middle. Because you're going to have some that are lower. You're going to have some wins that are about 5%, 10%, 15%. And you're going to have some trades that are the 20, 30, 40, 50%. So it all averages out once if you do it pretty decent, depending on your upfront costs, it's going to average out to about 25% is going to be what you want, your goal for your winning trades to average. So that's kind of what I'm saying. It's 20 to 30% average right in the middle, 25. So if I'm going to try to put numbers to it, if you got 17 trades making 250, which is low end, and you have 3 trades with a full loss of $1,000, the net is going to be 1,250, 4,250 minus 3,000, 1,250. That's basically I'm about a month of trading, doing nothing but first target only. If you want your 250 to average up to $30 or more, you got to trail stops, and then you're going to have some trades where you're getting a 50% return, 60% return, 70% return. Over the last month, we had several of those type trades where we're catching big moves like that. And that adds up really fast. But like I said, your worst case, first target only, comes out to a 10 to 20% annual return. That's doing what I just said, just put the first target averaging about 25% return per trade on winners, averaging, and the full loss. That's basically how you do that math. So you have to have an expectation, and you do that month after month. But you will have losses. So you have to expect the losses, and you have to factor them in. Not just how much you're going to make, but you have to factor in how much you're going to lose. Everyone always thinks about how much they're going to make, but a lot of people don't think about how much they're going to lose. If this month you made $4,000 and you all then $4,200 and you lost $300, that's a good month of trading. That's a good month of trading. It's the net results. It's not how much, oh no, I gave back. No, that's trading. You're going to make money and you're going to give back money, and it's all going to be net results. And $1,000 would be based upon a 50 grand account with, that's 2% of the account. You're risking 2% of the account, $1,000. You want to make twice as much, you risk twice. If you were risking $2,000, then instead of making 1,250, you would make 2,500, risking $2,000 per trade. You risk $4,000 per trade, you'd be making 5,000 for the month. So that's how we trade. It's all math and numbers and stats. So long as we maintain placing at least 10 to 15 trades a month, at least, the numbers work themselves out. Olga. So you got on there briefly. Any questions on this so far? Because I want you to have a good understanding of the numbers, how we make money. It's you want to do a little work as possible to make as much money as possible. But if you put in the time effort to trail the stops and manage positions, you will end up making more, and you will feel good about it, because when you're in that trade where you're doubling your money on the second part of the trade, it just sort of feels good. Okay, just sort of feels good. All right, any questions at all so far on anything? I'm going to scroll down here. If anyone has an interest in learning all the strategies in detail, this is my options coaching program. It's going to be all the Donchians plus the ones for market tops and bottoms. It's actually 6 strategies. And that's going to cost us $17.50. I do everything one-on-one. If you want to work with me in person, I'm available in person in the city of Santa Clara. We can do in person if you want to do in person. Otherwise, we work via Zoom. I provide you every 3-4 months. You get all the updated stats for all the ETFs for each strategy. Becky does that. Sends it to me. I send it out to everyone every 3 to 4 months. And this is the real important thing here. I'm finding out more so even recently, doing a monthly review of your trades. We want to make sure that any losses you had were valid losses. What I found out recently talking to some people, they've been seeing losses dating back months and months and months, but didn't really check with me. So when we go back and look at the losses now, there might be 8-9 losses, and they should not have been losses. They should not have been losses. For whatever reason, it could be the broker error, it could be the trader error. But we can't go back months to see what actually happened. As we found out from the broker, if you put in an incorrect order in some way, shape, or form, you put in a target wrong, you put in something wrong, they can check that for up to the last 30 days or so, but they don't keep your specific order details on file for more than about 30 days because there's so much information to maintain. So they can go back up to about 30 days to see what is it you actually typed into your order form, not just the end result. So that's why each month we want to look at our trades, see what losses we had, and were they valid losses. There was a trade I had on several months ago, and I looked at it, I was thinking, hey, this must have executed. I was expecting a really nice profit because the market went up, my calls were executed. I look at my position and didn't execute. I'm like, what the heck's going on? Did I do something wrong? And further thought, I did something wrong. I looked at the order form, looked great. Didn't see any errors on the order form. Okay, so I called the broker and they looked at my order form, they looked at the market, they looked at what sometimes this stuff happens, but no stuff had happened. The market went up, my trade should have executed. And when they closed my existing position, it was now at a loss where I should have had a 30-40% return on an option trade, was now at a significant loss because it went past my target. It was actually at my second target, didn't execute, came all the way back down below my first target, and was now at a negative. And the broker said so they closed my trade at a negative to get me out of it, and did research on it. And they came back a week later and told me there was no valid reason my trade should not have executed. They gave me a full refund of my money, plus the profits I should have made at the first target. And your brokers can work that on your behalf. But it's up to you to be aware of your trades in a timely manner and what's going on with them, okay? And be nice to the broker, even if they aggravate you a little bit, because they can either help you or say, yeah, we'll get back to you on that, okay? So when you have a problem, the broker can help you, even if it might be aggravating at times. Be nice to them, okay? And try to be professional, even though you want to yell at them, don't do that, because we need them to help us when we have problems. But yeah, sometimes it's our fault because we made an error on something and it didn't execute properly. Sometimes it's a valid loss, which is perfect. Or sometimes your trade should have executed properly, but the broker had some kind of error on their side, and we need to know that, okay? So that's one program. That's for just the 5 daily chart strategies, or 6 actually. And this program is for people who already trade options. This is for people who have some experience and want to get right into it. And I don't have to tell them, this is the call, this is a put, this is open interest, this is the we don't have to deal with options basics. You know your options basic. You've already been placing them trades. This is for you. This is for people who want to add more profitability to their accounts, who want to add something to what they're already doing. The second program is for people who are brand new. This is where I will literally hold your hands. We're doing the weekly, daily, and the market internals. The market internals are the ones that have quite absolute bottoms. Before anything turns up, we get into market internals long. This is for people who are brand new to trading, as well as people who are very experienced and want to add more stuff to their trading arsenal. But for the new traders, I will help you get your account set up, help you get all your charts set up, handhold you. I will be online with you when you place your first trade. Whatever you need, I will be there to, if we do it. Sometimes I've done this actually in person with people placing their first trades, actually in person. If it need to be in person or online, we can set that up. So I'm literally holding your hand, helping you fill the order form out, everything in detail. But this is for new people. So and several people have needed this because it's really helpful to have someone hold your hand, make sure you don't make any mistakes. And it's not a subscription. This is for Anu. I usually tell you, you have to commit to at least 6 months. You have to commit to at least 6 months, okay? Because that's what you need to see the end results. Because you got to be able to be doing it long enough to go through the ups, go through the downs. At some point in time, you will have 20 trades on at the same time, and every single one is going against you, and you'll be cussing my name. You will be. You might even call me up and do it. I've had that. It's normal. Because you think you're going to lose all your money. You got 20 trades on. The long trades are going the wrong way. Short trades are going the wrong way. Expiration is coming up. You think you're going to be screwed. But here's what happens. That's why we need the 6 months to trust the stats, trust the methodology, trust me, trust yourself, trust the markets. When those 20 trades are all going wrong at the same time, somehow, some way, by expiration, 87% of them are going to reach the first target before expiration. It just does. But that's why you have to trade and commit for that much time. $17.50 is a one-time fee, not per month. I know there are programs out there like that that pay much per month, but it's $17.50 is a one-time fee. And once you do that, you also have access to our Facebook group. In the Facebook group, each evening, we post what the valid trades are for the next day, so it helps a lot. So it can help confirm what you found. Some people rely on that Facebook group a lot. They don't always have the time to do the review themselves, so they rely on the Facebook group to see those trades, and it really helps you. I like cold-blooded swing trading. I like that, David. It is cold-blooded swing trading. That's exactly what it is. Cold-blooded. The less emotional you are, the more money you're going to make. How well did you do during the COVID scare? You see, that was what I was showing. How that was our most profitable trading, because it doesn't matter, COVID, a war, anything doesn't matter. Elections, it doesn't matter at all. I'm going to go back to the charts real quick. All right. This is what I was showing earlier for the. I'm going to pull up the different chart. I'll pull up the Qs. Pull the NASDAQ. This is NASDAQ. This is the NASDAQ going from 235 down to 170. That's a massive, massive, massive drop. We got our sell signals all through here. We got multiple sell signals here. The sell signals became so profitable, we didn't have any more profit to take. The options were doubling and tripling in value, literally doubling and tripling in value all the way down. And that's for the options. Now we have also the futures going on too. So, and so the futures is even more cost effective. We don't have to deal with the volatility. But yes, the options we got in option trades up here. And when they started gapping down, the gaps were such massive, massive gaps, they doubled and tripled in option price. So extremely profitable all the way down. The third program, that's about the third program. I'm gonna go back to the share. But yeah, it doesn't matter what's happening in the world. A buy signal, still a buy signal, a sell, still a sell. And it's all about the probabilities. That's why we do objective trading. We don't care why or what's going on in the world. It doesn't matter at all. Doesn't matter COVID, doesn't matter if someone's blowing something up, an oil leak, couldn't care less. The third program is for a combination. This is a full options program again. And the third one is for futures and options together. So if you want to do it's basically, it's $17.50 for the options and $17.45 for the futures. Since we didn't do the futures specifically today, I didn't detail futures by itself, but the futures by itself is $17.45. And that is 7 index future strategies and 3 currency future strategies is what the future strategies are. And those, so together, it's probably one of the better deals is to trade them both, because together it's beautiful trading. How I do things now, as I keep always evolving. What I'm doing right now, I take every single futures trade. Every single futures trade that is valid, I'm in it. And that's for the currency futures and index, the Dow, NASDAQ, S&P, and Russell 2000 futures. Then on top of that, I use options to trade oil, natural gas, gold, and energy. So most of my option trades now are those commodities. So I use options for those commodities. And then I use the futures for the major markets. So that's how I blend my trades together now between options. But each individual is different. Some people would do more options. Some people do more futures. Some people do a mix of them. Some people try to do them all. But that's how I'm doing it right now. By sell signal, I mean we have a signal to go long and a sell signal to go short. That's what I mean by sell signal. We have multiple strategies, crossover strategies, using trigger lines. Those are linear regression lines or linear regression curves. So sell means we go short. Buy means we go long. All right, futures is such a beautiful market. Yeah, David kind of got into those future strategies because they make money quickly and you don't have, and it's a faster turnaround time. Options, you're in a trade anywhere from a few days to maybe, most trades are less than 5 weeks, but some can go 2 to 3 months. With the futures, most trades last from a few days to maybe 1 to 2 weeks at the most, in most cases, before the first target's reached. All right, so do we have any questions on anything having to do with the strategies? This is going to be our last meetup for 2021. We got the holidays coming up and everything, so we probably won't do another one until maybe the second week in January. I am available by phone, by email for any questions. If you are already trading the strategies, want help, let me know. Want to review your trades, let me know. If you're interested in finding out more, getting more details or any of the coaching programs, let me know. Email me or call me and we can chat, go over your specific situation. And we can see what we can do. If you, on my phone number, thank you, Becky. It's also on the handout. So if you download the PDF for the handout, we put it there. So I knew the handout is on there with all my contact information. That's my direct phone. I'll be around the rest of the afternoon that Becky just put out there. And my email, you just email me once again, or contact me off the website. The contact form from the website has all of our information also. And we go through your specific situation and set something up. Right now, we're going to be doing active trading until expiration Friday in December. Between expiration Friday in December and the first week in January, we're off. There's no trading. It's like a dead zone. Volume drops off, the technicals are off. We don't trade between December expiration Friday and the first week of January. No futures, no ETFs, no options, no stocks, nothing. It's a dead zone. We can't trust the technicals. So after the new year starts up, the first week of trading goes by, everything settles down, then we get back into it, okay? I use the brokerage I use, well, I forever had Options Express, and that Options Express was taken over by Schwab, and Schwab basically took the Options Express platform and put their name on it, changed it to Street Smart Central. So now we trade on Street Smart Central under Schwab. And as most of you already know, Schwab, TD Ameritrade, they're all one big happy family, you know. But they're still a separate platform. So I trade on the Schwab Street Smart Central platform for both futures and options. A lot of people I know also trade on Thinkorswim for futures and options. I really like the Schwab platform. It's simple to use, very easy, straightforward. Other people like the more complex Thinkorswim. Either one's fine. I know some people who use E-Trade. That's fine. You just have to make sure that the platform you're using has the capability of placing conditional orders. Several popular platforms, they may be popular, but they can't take out trades because they don't accommodate conditional orders. And what I mean by that is a conditional order is saying when the ETF reaches this price, execute an option trade. That would be a conditional order. So not all brokers can do that, or platforms. All right, any questions, anything at all? You can go about anything you want. Strategies, trade management. Otherwise, we're gonna call it until 2022. And let's see, how long have you been trading? We started in 2005. Like a lot of people, myself and Becky went to this business seminar. We're showing different types of businesses, and one of them they showed us was trading at a company, an educational organization. Some of you, I won't say the name, actually they're gone, it doesn't really matter, but they showed us we can buy on 3 green arrows and sell on 3 red arrows. You all can figure out who that is if you've been around for a while. So we bought into that, paid our whatever, $3,000 to $5,000, started trading, immediately lost $5,000 right off. That's like that, lost $5,000. First trade, UNH, United Health, because we bought 3 green arrows and then the market just dropped. Educational organization didn't tell us anything about risk management, about how much to risk versus account size, so on and so forth. They didn't want to do any of that stuff with only the $3,000 package, unless we bought a $20,000 package, then they might have told us that. But I'm not joking about that. All right, so I will catch you guys later until January. So you guys all have a good end of the year. You need to reach me about coaching, just call me or email me or contact me off the website. And hope your training goes well, and I'll talk to all you guys soon.